Good morning. My name is Cheryl Hunt. I'm the Chief Marketing Officer here at Carr and Ingram, and it is my great pleasure to introduce Doug Mims. He is a partner out of our Atlanta office, and he is a subline leader for our financial institutions, and he is going to be presenting to you today. So I will go ahead and hand it over to Doug.
Okay, thank you, Cheryl. And thank you, everybody, for taking time out of your schedule to be with us today. Our topic, as you know, today is liquidity risk for community banks. Obviously, there's been a lot of discussion about liquidity, particularly at the regional banks that have had issues and have ultimately, in three instances, resulted in closures. So we thought it was a timely topic to kind of provide an overview of the current environment and also talk about what community banks should be doing as we move into this year, 2023. So, whoops, I jumped ahead of myself. So today's agenda, we're going to look at the U.S. banking landscape, and that's basically just do an overview of the size and nature of banks in the U.S. We're going to talk about what a community bank is. I know we have a lot of community bankers on here and clients and others that we know, and you're probably wondering, why would you do that? Well, we have a diverse audience. We have people in our firm that work in the banking practice, those that don't. We also have external parties that are in banking and some that aren't. So thought it was worth differentiating there. We're going to go through the three scenarios of the banks that have been closed, and then talk about what the regulatory response was and kind of where we are in the current environment, and then talk about liquidity risk management fundamentals. So what's the banking landscape look like? So I actually like to do this. I obviously make a living serving community banks and other lenders, and I like to kind of see the lay of the land, if you will, from a size perspective, how many financial institutions are out there and so forth. So I probably went a little too far with the data, but it'll give everybody on here a good view of what a community bank is. And I think or what a small bank is. I think one of the things that I noticed in the reporting and continue to notice in the reporting is there's references to small banks, and they've referenced the institutions that have been closed as small banks. And I think that's a little bit of a misrepresentation and could provide the perception that the local community bank is a small bank that they're talking about. Well, it is a small bank, but it's not, it's kind of out of context. So there's 4,715 banks and savings institutions that filed Carr reports as of 12/31. Four of those banks are over $1 trillion in assets. So that's your JP Morgan Chase, the Bank of America, Wells Fargo. They're the largest four what I call money center banks in the United States. The top 10 banks hold about 65% of the deposits in the U.S. The top 15 hold about 75%. So most of the deposits, the overwhelming majority of the deposits in the U.S. are held by the largest institutions in the United States. Just as a kind of give you some further context. So you have four that are over $1 trillion. Then there are 30 banks from 100 billion to $1 trillion. There are 30 banks. Then from 10 billion to 100 billion, there's 126 banks. So the importance of that is, so at 12/31, and this is obviously before the closures, there were 160 banks over 10 billion in assets. A bank, as defined by the regulators, a bank less than 10 billion is considered a community bank, which may be a little on the high side to some degree, but nonetheless, there are 160 institutions over 10 billion in assets. So they are not small banks and they are not community banks. From there, if you kind of look under the 10 billion threshold, between 5 and 10, there's about 119 banks. Between $1 billion and $5 billion, which is where a lot of our clients are, under $1 billion, and we're really from de novo to $5 billion. In the 1 to 5 space, there's 710 banks, which is 15% in number. And then less than $1 billion, there are 3,726 banks, which is 79% of banks. So if you roll that all together, about 97% of the banks in the United States would be under 5 billion in assets. And those are small banks. So when the media, business media, other media talks about small banks, that's really a small bank, but they're kind of taking it out of context. So that's kind of the point. Approximately 40% of the total deposits in banks are uninsured. And that was a big part of the discussion that's taken place is the concentration of uninsured deposits at these institutions. So keep that 40% in mind as we kind of walk through these institutions. So what does a community bank look like? And this is just a few bullet points. I know as from a community bank advocacy standpoint, I could say a lot of other things, but this is more just informational to kind of give you all, both bankers and non and other context about what a community bank is. So generally a community bank would be less than 5 billion in assets. They would have a limited geographic footprint, might be in a couple of local communities, could be multi-state, but normally would be in the same state as far as footprint. Community banks tend to focus on commercial lending, and they often have concentrations in real estate lending as a consequence. Roughly 60% of small business loans are made by community banks, and 80% of agricultural loans are originated by community banks. And for a frame of reference, going back to the 40% uninsured deposits, 9%, the average across the board, community banks, about 9% of their deposits are uninsured. So significantly less than the aggregate average of all institutions when you're thinking risk profile. Okay. So there have been 3 recent regional bank closures and one shut down, Silverton shut down, but and I guess they wouldn't have qualified as a regional bank, but not Silverton. Yeah, I'll think of that in a minute. But so 3 regional bank closures. So I'll cover those, kind of give you some ideas. And everybody's seen some of this, so I won't spend a lot of time on it. But I do think it's important because there's characteristics here that have nothing to do with a community bank, and I think that's important to note. But there are some fundamentals in here that'll flow down to the community bank level, maybe trickle down, maybe flow down from a regulatory perspective. We'll kind of see how that plays out. So Silicon Valley Bank was the 17th largest bank in the U.S. with 209 billion in assets. So they were not a small bank or certainly not a community bank. They had a concentration in loans to venture capital and PE firms, about 56%. 94% of their deposits were uninsured. So, and 13 billion of those were concentrated in 10 depositors. So high concentration, and they even had a concentration within the concentration. So 94%, again, going back to that 40% across the board, and 9% at community banks. So very different risk profile. They had a bond portfolio that included 90 billion in held to maturity securities that had 15 billion in unrealized losses. So those loan losses were not realized. They were, in fact, not recognized anywhere. They were disclosed, but they would not have flown through the P&L or equity. Kind of the timeline here, they announced a $2 billion loss on a bond sale. They were trying to free up some of those bonds, and they sold them at a loss. They were also having a corresponding to that, or at the same time, they announced a capital raise on March 8th. The stock collapsed on the 9th amid 42 billion in attempted customer withdrawals. So that kind of ran together. I probably should have had a comma somewhere. But so they announced 2 billion in losses related to those sales. There was a corresponding capital raised. In the meantime, the stock collapsed the next day, and all the while they had customers on withdrawing 42 billion or attempted to withdraw 42 billion. That was a high-tech digital run on the bank. So, which is something none of us had ever seen, probably had thought about, but none of us had ever seen. So a digital run on the bank to the tune of 42 billion in attempted withdrawals. As a consequence, the bank was closed by the regulators on March the 10th. So this all happened very quickly. And they were subsequently acquired by First Citizens Bank out of Raleigh. It was the second largest bank failure in U.S. history, and the estimated cost to the Deposit Insurance Fund, which is the fund that's set aside to cover uninsured depositors, and it is funded through assessments on banks. They fund it through special assessments. That Deposit Insurance Fund, the hit to that was $16 billion. I will talk about a little bit more in a minute about what some of the issues were, but primarily, if you go into that, there was actually a report issued in the last couple of weeks by the Federal Reserve Bank that the Federal Reserve indicated that kind of went through the reason Silicon Valley Bank failed and the supervision, meaning the regulatory role in that. I think they really, a lot of basic things did not appear to be being done. A lot of the issues that gave rise to this failure were not new. They had been around. The regulators had pointed them out in a variety of communications, both formally and informally, and they simply had not remediated the issues. So as a consequence, they failed, or they were closed. Signature Bank had total assets of $110 billion and deposits of 83. So a little smaller, about half the size in terms of assets, but still not a small institution. 89% of deposits were uninsured, as opposed to, again, the 40 and the 9 and the 94. They did have a little bit of a concentration in crypto, which probably didn't help anything. It certainly was not, per what I've read and seen, doesn't appear to be the primary issue, but it was a contributing factor, and the contagion around that and the whole cryptocurrency thing kind of didn't work in their favor. But they did have a segment of customers that were in the crypto business in some way, shape, or form. The closure of Silicon Valley Bank and the shutdown of Silvergate, which is what I was trying to say earlier. I think I said Silverton, which is the old correspondent bank that was shut down several years ago. But the shutdown of Silvergate resulted in their customers withdrawing $10 billion in deposits. So they had a bit of a run on the bank as a consequence of the contagion and the publicity out there. They were ultimately closed by the regulators on March the 12th, and they were subsequently and ultimately acquired by Flagstar Bank. This was the third largest bank failure in U.S. history, with an estimated cost to the Deposit Insurance Fund of $2.4 billion. So not quite as costly as Silicon Valley Bank, but still certainly relevant. The regulators indicated corporate governance and risk management infrastructure had not kept pace with the growth of the institution. And the third closure was First Republic Bank. A little bit different than the other two in that it didn't have long-standing issues and other things like those institutions. Probably was viewed as a more well-run bank, but they did have genuine liquidity issues based on the model they had been running. They didn't jump into crypto or whatnot, but they certainly had problems. But 15th largest U.S. bank with total assets of $213. Their credit rating was downgraded in March due to a high proportion of uninsured deposits with wealthy customers and a loan deposit ratio of 111%. So they did have concentration. Their loan to deposit ratio was 111%, which is certainly not unheard of, but it's an indication of you got to find other ways to fund loan growth. And then the 11 U.S. banks subsequently deposited $30 billion in there. So 11 U.S. banks got together, made $30 billion in deposits to try to shore them up, and ultimately it didn't work. But that was at the request of the regulators, and they were not closed at that point, but they did receive those funds. The share price continued to decline, and the S&P downgraded their credit rating to junk on March 19th. Customers then did make a run on the bank and withdrew $105 billion across the course of March. And on April 28th, the bank announced plans to begin selling investment securities to try to create liquidity. They also announced substantial workforce layoffs, and the stocks corresponding to at the same time, the stock declined 43%. So the wheels started turning. Customers made a run on the bank. They said, hey, we're going to sell some securities and we're going to lay off a bunch of folks and right the ship. But in the meantime, it was just too late. They were closed on May the 1st, and they were ultimately acquired by JP Morgan Chase at an estimated cost to the deposit insurance fund of $13 billion. So that's some background. Some of that you knew, some of that you might not. There's a little bit of detail you might not want to know, but very similar issues. A high concentration of uninsured depositors, and technology and news and Twitter and all those communicative things didn't help any of them in any respect. So coming out of that, how did the regulators respond, and what's the current environment? I think I got a question up here. Let me see. And someone said it's possibly be great to get a copy of these slides, and we will provide a copy of the slides to all participants. So that'll be good. Okay. So regulatory response. The Bank Term Funding Program was created. It allows for banks to obtain loans up to 1 year using their security portfolio, investment security portfolio as collateral. And they're able to make those, get those loans at par. So even if the security is, even if the fair value is a security that's underwater, if you will, and the fair value is $90 on $100 par value, they could still borrow up to $100 for a year. So that Bank Term Funding Program was created and put in place specifically as a result of the closure of these three banks. The Fed discount window, which has obviously always been around and highly used, typically includes 1 to 5% haircuts from the amount that can be borrowed, and those were eliminated as part of this program. The Federal Reserve Board has subsequently raised rates twice, and kind of backing up just a little bit, another, and I think I did allude to this, but the securities being underwater is a direct result of the unprecedented increase in interest rates, both in terms of the number of increases and the extent of the increases. And therefore, interest rates, for those who don't know, have an inverse relationship with bonds. And so if interest rates go up, bond prices go down, and vice versa. So in this instance, these steep rates for longer term bonds have resulted in significant unrealized losses. And that puts banks in a position where if they were to dispose of those securities for liquidity purposes, they would have to do so at a loss. So subsequent to this, while they seem to be inclined to consider not making future increases in rates. On March 22nd, short-term rates were increased to 0.25 percentage point, and again on May 3rd. So those would continue. That doesn't have a direct correlation with long-term rates, and I'm not an economist, but it doesn't have a direct corresponding, but presumably that could have had a further negative impact on bond prices. So also, in order to replenish the deposit insurance fund, the FDIC proposed a special assessment for banks. Again, that's how. So when people in the news say, well, the taxpayers are not going to pay for us covering these deposits, that's true from a direct perspective. The deposit insurance fund is funded by banks, but presumably a bank who has to fund the deficit would seek to recoup those funds somehow, and oftentimes that's through increases in their pricing through fees and other things. So indirectly, consumers still pay for the replenishment of the fund to some degree. And in the meantime, I'm kind of a banking information, economic data junkie, if you will, and I keep up with what's going on social media, and in particular Twitter, and I have to follow some bank analysts and whatnot. And so there continues to be rumors out there about regional banks. I mean, it's to the point now where there are some banks who had some negative press about potentially having some issues. Aggregated deposits. They've actually put out press releases to say, hey, we've raised deposits, which is obviously unusual, but necessary in some instances, because they're all frightened that if it gets out there that they have liquidity issues, if it gets out there that people are shorting their stock, which is definitely happening, then they could have a run on the bank. And as we all know, or I know our bankers know, but any bank, if every depositor showed up on a given day to withdraw their funds, then every bank would fail, because nobody has all that money and all those liquid assets. And Jill Braniff just asked me what happened to the sound. I'm not actually sure where I went out. I did see it pop up and say my signal was weak. So I'll back up a couple steps. So, well, I'll just cover the last step. And if I need to back up further, somebody can let me know. I think I got a chat here. Let me see what it's saying. It came back quickly. Okay. All right. So I think it happened when I was talking about rumors. So the rumors can actually trigger a run in the digital age, and much more quickly than anything we've ever seen. And so these banks are trying to get out in front of that with positive press releases, if you will, which makes sense. Okay. I'm going to back up just a little bit. I have the FDIC puts out a quarterly report that aggregates bank data, and it summarizes aggregate bank data and maybe even breaks out some of the upper tier stuff. It also breaks out community banks to some degree, so we can actually see what's happening at community banks in the aggregate. So that report will probably come out next week. It usually comes out at month end, 2 months after the end of the quarter. So we don't have, I don't have that data yet. I have seen some data, some S&P Global data and whatnot, but nonetheless, this is 12/31. So I'll run through this pretty quick. So for the year 2022, community banks reported net income of $30.4 billion, which was down 0.3%. So basically flat between 22 and 21. What we did see in Q4, though, we saw net interest margin of 3.71 for community banks, and we saw that was a decrease from Q3 of 7 basis points. So what we're seeing there is in the liquidity arena, we're seeing that community banks are needing to pay more to depositors in order to keep their liquidity, if you will. And so that manifests itself through net interest margin. Obviously, we're hoping that our community banks will have a corresponding increase in their in the origination of new loans, but sometimes there's a timing issue. So we don't exactly know how that fleshes out, but we do know there's going to be net interest margin pressure anytime you have to increase deposit rates in a community bank. Of note, there were still $620 billion in unrealized losses at community bank. Actually, let me back up. There were $620 billion in unrealized losses on the balance sheets of all banks in the aggregate as of December 31. So that's just a note. I know it's hard to get context around $620 billion, but there's a lot of securities that remained underwater at 12/31/22. We did see loan growth year over year of 14.4% for community banks. Community banks, and this is not unusual, are in a little bit of a longer position. They're 54.7 of asset maturities are greater than 3 years for community banks, which is not unusual for a community bank. Stable credit quality metrics for community banks were, in other words, there was no significant credit quality issues perceived to be on the horizon. Deposits remained well above pre-pandemic levels. And we saw an increase in deposit costs from Q3 to Q4 of 46 basis points. I think that cost is across all banks, though. I don't think that's just community banks. I mix these in a little bit. And then the Deposit Insurance Fund, as of December 31, again, all this is before the 3 bank closures, had a balance of 128 billion. So that's where we started before all the chaos ensued. Let me look and see what we have. Okay. All right. So we'll press on. And I keep mashing buttons, but I'm good. Okay. The most recent information that I had ready access to came out last week, and this is where FDIC Chairman Martin Greenberg was testifying. I believe it was in front of Congress, and or he was giving a presentation, if nothing else, but I think he was testifying in front of Congress. And these are some things he alluded to in his report, which capture some of the Q1 data he's seeing out in front of that report being issued next week. So aggregate bank net income was unchanged from Q4 2022 to Q1 23. So that's all banks, not just community banks. Asset quality metrics remained favorable and the industry remains well capitalized. Now, this is from his perspective on 5/18 relative to Q1. We're not back at 12/31 anymore, we're at Q1. Assets with longer maturities and lower yields may continue to hinder earnings and adversely impact balance sheets. We know that, but I threw that in anyway. He's making that observation that longer maturities have an adverse impact on earnings as we move forward. And it inhibits a bank's ability at some level to fund loans, to restructure as needed, and to raise capital and other things. So not that it keeps you from doing those things, but it certainly doesn't make them easier. This was not quantified, but there was noted deposit movement to non-deposit alternatives and sources outside the banking system, which I think is what most people are most worried about. Not so much community banks, not so much losing deposits to a competitor. That's always an issue, but actually deposits leaving the banking system. Deposit costs appear to have risen more than asset yields. That's how he said it. In other words, the increase in deposit costs in Q1, the increase in deposit costs outpaced the increase in asset yields in Q1 in the aggregate. And hopefully we'll see next week what that looks like for community banks. Loan growth appears to have slowed as deposit outflows have continued. Liquid assets remain higher than pre-pandemic levels. That continues to be a reference, that a recognition that, hey, because, and for the non-bank folks, or people who might not know this, is that deposits increased substantially at community banks and at other institutions during the pandemic because of the government money that came out, PPP loans and other things. Those things were in the banks. So there was elevation of deposits, substantial elevations. In fact, people didn't know what to do with all the cash because there wasn't enough yield out there to invest in. And nobody wanted to go long if they could avoid it. So, but that money has come down and now we're back to a more normal level. Which hence the reference to, we still have more deposits than we did before the pandemic. Discount window borrowing after the 3 bank closures peaked at 153 billion before returning to 5 billion. The term loan program, if I understood what I read correctly, the term loan program is currently at the time, sometime in April, was at 81 billion. So the new program that I referenced earlier that was made available to banks has been tapped into to the tune of 81 billion. And then I happened to see another metric from I think it was a presentation at the Texas Bankers Association last week. There were a couple of good presentations, and one of the things that Janie said in their presentation, they had a graph that I saw. Q1 Federal Home Loan Bank balances are at an all-time high, just over $1 trillion. The previous all-time high was in the same neighborhood. It was around $1 trillion, but this is just a little bit higher, but that was back in the second quarter of 2008, I think. So the highest level ever, higher than even in the Great Recession. And it's an increase from, I guess, before all this started, of about 200 billion. So a little frame of reference there. for FHLB advances as a funding source. Okay. So if you're a community banker and you're going, okay, you kind of know what your challenges are. You don't think you have the same risk profile as the banks that have been closed, because you probably don't. And you're saying, okay, well, what should I be doing now? Well, from our perspective, or from my perspective as a bank auditor and somebody who serves the industry, I thought it would be helpful to kind of go through the fundamentals of what the regulatory expectations are and have been, with the expectation that regulators are going to look more closely at liquidity than they have been. I know there was already a trend where they were looking at interest rates. And so the concern about funding through deposits at community banks is not new. That's been going on. I mean, all banks have been, since the pandemic funding came down, everybody has been kind of reassessing their deposit decay rates, and in some of the modeling have been looking at the impact of a reduction in deposits. Also, what does it look like when I have to increase prices in a rising rate environment on my deposits, and the related increase in loans, and kind of what does my net interest margin look like? And so you go through those shock scenarios. So this is not new, but I think at the end of the day, that interest rate risk directly impacts liquidity risk as it relates to deposits, and also as it relates to the unrealized loss on securities, which takes away a funding source. So just a little fundamentals. This is from a regulatory perspective. So liquidity is a financial institution's capacity to meet its cash and collateral obligations at a reasonable cost. So that's important. Like, there's a lot of ways to meet liquidity needs, but can you do so and still be profitable? That's really the way I view that. So that's an important caveat. Obviously, any banker on here has that absolute intent, is to meet liquidity needs and make money. Liquidity risk is the risk that an institution's financial condition or safety and soundness is adversely affected by an inability to meet its obligations. But it also says, or perceived inability. And I think that's a big one, because everybody's concerned about the perception. And I will say this, of my clients that I've spoken with about it, which is most of them, prospects, others I know in banking, we don't have any community banks that have had any runoffs. Most of our community banks have stayed about even. I've had some that have said that the deposits have increased, that some of this concern about regional institutions has resulted in inflows. But for the most part, I think we have seen in our clients to this point pretty flat. But that perceived inability is important, because that perceived inability is what resulted in the digital run on those regional banks. So from a regulatory perspective, and this is not new, but I think it's worth reiterating, and I won't beat these two sections, the next two sections to death or anything, but from a corporate governance standpoint, this is talking about the board, not management, the board. So the board should understand the nature of liquidity risk and periodically review information necessary to maintain the understanding. So the FFIEC guidance that's been out there since 2010 clearly puts ownership of this with the board. And the board should establish executive level lines of authority and hold management accountable, if you will, for effectively managing liquidity risk. And then also, specifically, the guidance says that the board should understand and periodically review an institution's contingency funding plan. So contingency funding plans, while I think they're going to look at liquidity in general, and it leaves maybe in a different way than they have before, and they may look at governance, and they may look at policies and procedures, which I'm going to hit on in a minute. But if nothing else, I feel confident that they are going to scrutinize contingency funding plans. And we're going to cover those a little bit more in depth than this other stuff in a minute. But I think that's where the focus will be, is with contingency funding plans. So here are some of the things that your liquidity policies and procedures should address. So I'll run through these rather quickly. for time's sake, and as I mentioned earlier, the slides will be available for all participants. They should include the primary sources of funding for meeting daily and seasonal and cyclical cash flows, strategies for addressing alternative responses to various business scenarios, the formulation of plans and courses of action for dealing with potential temporary, intermediate, and long-term liquidity issues, a liquidity risk tolerance appropriate for the business strategy of the company and the related liquidity risk profile of the community bank. Provisions for documenting and periodically reviewing assumptions used in liquidity projections. So the policies and procedures should address how assumptions get addressed. And assumptions will come up a couple of times, because within contingency funding plans and the stressing and testing of those, assumptions are really important. Scenarios are important and assumptions are important. And I think it's worth stressing that you need to, we'll cover that when we get there. But theoretically, they should be in your policies and procedures. Here, some things, again, quickly that you need to have in your policies and procedures. You need to have quantitative targets and qualitative guidelines. And those need to address things like cash flow projections, including, mismatches and gap analysis, target amounts for your unencumbered liquid asset reserves. That's the things that you can readily convert to cash. Thing I think of when I read that is investment securities. Are they, if they're AFS, then they're readily saleable, but if they're a loss position, is that feasible? Measures used to identify unstable liabilities and liquid asset coverage ratios, asset concentrations that can adversely impact liquidity risk, funding concentrations that address diversification of funding sources, funding concentrations that address the term repricing and market characteristics of funding sources, and contingent liability exposures such as unfunded loan commitments, standby letters of credit, and those type of things. So I'll give you this for you'll have this for reference if you want to make sure you've got all that appropriately addressed. And then the last item, policies and procedures should clearly indicate the nature and frequency of management reporting. That management reporting, both internally, however you have it structured, if you have management ALCO and then a board ALCO, or if you might have an ALCO that's has both, and then you report to the board. Whatever that mixture is, it needs to be articulated in your policies, and you need to be doing it. So this is practice. So that's governance, policies and procedures, practice. What are the things you need to make sure manifest themselves in your process? Well, one is robust stress testing. You should conduct stress testing on a regular basis in a manner that is appropriate for your liquidity risk profile. You should have a process for managing your collateral positions. Let me check and see if I've got a chat item here. Okay. Oops. Should also address, oh, sorry, I can't get this off here. Okay, I'm going to back up just a little bit. They're telling me we're out of time, which I need. Management reporting, you should include critical assumptions used in your cash flow projections. You should have an intraday liquidity strategy in place. Obviously, that depends on the size and risk profile of the institution, but you need to have that in place. And here's some things you need to think about. So I'll share those with you in the slides. You need to have a diversified funding that includes all the possible ways, including things such as deposit growth, sale of securities, asset securitizations, borrowing, broker deposits. All those things need to be in place and addressed in your practices. And obviously, I'm speeding up. Cushion of liquid assets. You need to clearly define your liquid assets as part of your liquidity risk management process. So, trying to make my way to contingency funding plan. So, and this will be where I'll wrap it up for you. So, every institution, regardless of size, needs to have a contingency funding plan. That plan should clearly set out strategies for addressing liquidity shortfalls in emergency situations. It should delineate policies to manage a range of stress environments, establish clear lines of responsibility, articulate clear implementation and escalation procedures, and be regularly tested. So your plan has to be tested. The contents of your contingency funding plan should include, identify stress events, assess the levels of severity and timing, assess funding sources and needs, and that needs to be done by virtue of a liquidity gap analysis and stress testing. And again, I wouldn't just do the same old, same old. I would definitely revisit how you're looking at liquidity gap analysis, how you're really revisit your contingency funding plan in general, and also your stress testing. I think that I saw a statement last week coming out of Tennessee Bankers also that banks need to get accustomed to being stressed. And the point was stress testing is key. And I think this is where the focal point will be in your contingency funding plan. So you need to, your CFP needs to identify potential funding sources, establish liquidity event management processes, and establish a monitoring framework. And that would include, any warning indicators as well as event triggers. And lastly, internal controls. So management should ensure that there are internal controls around all these processes that's appropriate, both from a data management perspective, from a reconciliation perspective, all the things that review perspective, all the things that you would expect need to be around this process to ensure that your liquidity risk management and your CFP process, if you will, has integrity. The thing I would also point out is that your liquidity risk is required to be reviewed independently on a regular basis. That review can be done internally by someone. Most community banks have a third party do it. I would encourage you to have somebody do it. And really, what I would encourage you to do is take a look at the fundamentals, take a look at the processes you have, really vet those processes, be critical of them, and also make sure they're complete. Make sure you've thought of everything and brainstorm and try to bring all that thought process in there. There are a lot of great firms out there that work in the asset liability management space and liquidity space that can be helpful in that process. And I'd also encourage you to have somebody do that independent review that will be critical of it and scrutinize it. And also that is maybe a focused liquidity risk review, as opposed to just kind of taking a look at your CFP as part of a broader internal audit program. I will say at Silicon Valley Bank, the regulators most definitely criticize the internal audit function for the nature and extent of the process in general, but specifically as it relates to their independent review of liquidity. So with that, I've gone over 14 minutes, which does not surprise me. Hopefully you hung with me. I'm checking the Q&A and I'm checking the chat, and we don't have anything in there. So with that, I think I'll turn it back over to Cheryl and let her close us out.
Thank you, Doug. All right, I will go through just a couple of housekeeping things. This is a quick hit format, meaning that there is no CPE available. These are meant to be just quick, timely, educational little short sessions for you. So bear that in mind. There is no CPE for this, but there will be slides available. Those will be available on our website, cricpa.com. We will also include those in a follow-up email. So if you are on here or registered, you will get that in a follow-up email. If you enjoyed hearing Doug talk, he is speaking all over the place. You can check out our website, and it shows where Doug is going to be presenting and or has been speaking in the past. He also writes loads of articles on our website, and you can catch him on our podcast. It's called It Figures. You can find it on all major platforms and on our website. So check that out. And we hope to see you again soon. Thank you all so much.
Thank you.